All right, it's go time.
Hello, everybody, and welcome to the Catalyst Funding December 2024 Real Estate Market Update webinar. We're glad to have you here for the special start time at 1 o'clock Central with our Catalyst industry experts. I want to introduce to you our founder and CEO of Catalyst Funding, Wade Comeaux.
Hello, everybody.
And we have with us Jeff Johnson, our Director of Lending.
Hello.
And one of our favorite special guests we have with us today, the CEO of Total Wealth Academy, Steve Davis.
Hi, everybody.
And Wade, I'll turn it over to you so you can talk about our long history with Total Wealth Academy and why we love to work with Total Wealth Academy and Steve Davis.
Yeah, for sure. I think Total Wealth is an absolutely incredible mentorship organization, and we work with a lot of their clients. We work with a lot of the same people. And the thing I love most about what they do is that they do a fantastic job of not just mentoring people on real estate investing. It's a very broad-based, holistic approach, helping people just live a better life overall. We get so many compliments from our clients on how Steve and his team have just made a huge impact. So, Steve, we always enjoy chatting with you. Great info. I'd love to hear more about what's going on for Total Wealth Academy in 2025. What are your goals? What's the plan?
Well, 2025 is going to be an interesting year. We're kind of getting into the forecast, but I think it's going to be a pretty flat year for real estate, which means there's still going to be a lot of opportunities because there are a lot of opportunities now. I think that the members of Total Wealth Academy are going to continue, the students are going to continue to buy as many single family houses as they can. And we'll probably pick up somewhere between 20 and 30 commercial properties next year as well for the passive investors.
Wow, that's exciting. So tell us a little bit about that commercial market. I know there were some challenges that present opportunities with great increases to interest rates, increases in taxes and insurance. And I know that you guys have picked up some pretty good opportunities in that space from what I hear.
Yeah. There's a deal going down right now that's 27% less than what it sold for in 2022.
Wow.
So you can be optimistic and realistic in assuming that thing is worth a lot more than we're paying for it. We even got fixed 7-year financing. I think you made the point. All of these quote unquote tragedies that occurred put people in a position, the inexperienced investors, the out-of-state investors, put them in a position where they needed to liquidate assets in a short period of time. And to do so, they had to deeply discount them. And we were there to take advantage of those situations.
Yeah, that's Warren Buffett said that famously once before. The time to buy is when there's blood on the streets. In all honesty, at times like this where many people are afraid, that's often when the best opportunities are presented. Some of the most wealthy investors I know are people that really went aggressively in that time. And, 2009, 10, 11, 12, in both single, multifamily, commercial, all three of those, they really crushed it. So it's important to have a measured approach and realize that when there's a lot of fear, that often means opportunities, right?
Absolutely. If you go back to 2008, 9, 10, 11, I picked up 20 or 30 single family houses and I totally goofed up. What did I goof up? I should have bought 80 to 100.
Exactly. Well, let's dive back into the rest of this and do a quick disclaimer here, just saying we're just giving our opinions today. You always want to do your own due diligence regarding any investments or decisions that you make, but we're just providing our best guesses and opinions for what's going to happen in the future and our evaluation of the data that we have. Next slide. Very briefly want to talk a little bit about Catalyst. A couple of key things I want to point out in this current environment. There are a lot of people doing cash out loans at the moment, both on their rental properties and on their owner occupied properties to take advantage of some of these deals that Steve is talking about and that we're seeing as well. I can tell you in the past month or so, I've seen more deals with very little out of pocket on single family, just crushing the ROIs at the moment. People are willing to go a little bit further outside of the major metros
Yeah.
and take on some opportunities that may have a little bit bigger project size, and they are just crushing deals. I've probably seen out of the last 10, maybe 6, 7 that were under $5,000 out of pocket, which is
Wow.
unbelievable. Now, don't get me wrong. If you're going to be in the more populated areas, you're going to have lower repair budgets. You're going to have great cash flow, great school districts. You're still going to have some bigger out of pockets, but some people are being a little bit more risk taking, and with that often comes lower out of pocket. The last thing I want to mention is that we have some new DSCR products. We've talked about them a few times, but we do have some DSCR products where you are not required to have a lease on the property, which is really exciting. Get in and out of those properties a lot quicker when you do the hard money to refinance process. And we are also able to offer that very exciting bridge appraisal on DSCR loans once we've made this transition to NRL. You may have heard about in the past. So very exciting opportunities in those two spaces. Jeff, anything else to cover in the product area before we move on?
Yeah, I was just going to mention, like you said, doing a lot of DSCR deals, really great products. No, also one thing, there's no seasoning. I don't know if you mentioned that or not, but we have a product where you don't have to have the property for the 6 months, right? You can get in and out of these projects really fast. The one thing that I will say about what you're talking about earlier with the investors, yes, going outside of the suburbs and a little further out, you're getting some great deals. And just talking to some agents that I know, I think people have forgotten what it was like during COVID and maybe shortly thereafter, where, if you had a deal when you're cash out of pocket, if that number started in the twos, meaning less than 30K out of pocket, you were very happy with that deal. That was a good deal back then. Now, they've got some investors they're bringing deals to say, hey, I want a deal. I want a property. I want to be a real estate investor. They're bringing deals for 5, 10, 15,000 out of pocket, and some of the investors are passing. So I think experienced investors that have a little perspective on the market today versus where it was in the past, you can be gobbling up a lot of these opportunities, because a lot of the folks that are newer, they just don't quite get it. They focus on cash flow too much, and don't realize the deals they can get for 10, 15,000 bucks. I mean, those are steals. You would, like you said, Steve, you wish you would have bought 80 properties back then. Now is the time to those guys. If you have some cash flow or you have some money, then you want to be aggressive. Now is the time to buy those properties, because they're still out there.
Yep. That's just a pro tip. Focus on return on investment and not simply cash flow. Cash flow is too simplistic of an evaluation. If you're out of pocket 100K and your cash flow in 500, that's not great. If you're out of pocket 5K and your cash flow in 200 and you get great equity capture, that's a very good deal.
Yeah.
All right, let's dive into Houston. And Steve, I'd love to hear what you're seeing in these numbers and just your overall gut on the Houston market at the moment.
Yeah, when you're doing predictions or forecasts, I think people need to be aware that these forecasts are very location related. You can't really do a forecast for the entire country.
Sure.
The different markets, they're all different, and there's going to be some that excel. What do I think is going to happen in Houston and really all of Texas in the next year is just, it's going to be more of the same. I don't see any dramatic changes coming, but I have to admit that there are more foreclosures right now, more short sales, and just like you said, more discounting. More people are discounting their properties to sell them. So I think the opportunity is going to remain through the year, but it'll be flat as far as the numbers.
So those foreclosures, I'm curious, those foreclosures that you're seeing, are you seeing those in single family space or commercial space or both?
Single family. Single
Okay.
family was what I was referring to.
We'll have to put
That's
together
interesting.
some foreclosure data for the next meeting. Yeah.
Yeah, because I see that in San Antonio a little more than Houston, Dallas. I had not heard that regarding Houston, so it is interesting.
Yeah,
so what do you think is the cause of that?
Realty team leader brought it to me about 2 days ago. So he may have been going off of national numbers, which, is dangerous to do. So let's do some research on that.
Yeah, I do know that despite a lot of net migration into Florida, there's a reasonable amount of foreclosure in Florida at the moment because they had a much bigger spike than we did in any area outside of Austin in the state of Texas. Austin had that massive spike in
Yeah.
values, but I have heard some foreclosure trends in Florida and a couple other pockets. But I'd love to see some data here in Houston. We'll make sure and research that. Derek, our expert researcher, will be on that for our next meeting. I did want to go over a couple of numbers that I see from the data from this month. So, whenever you look at the year-over-year numbers, and we went through a few of these, and Houston and Dallas still seem to be the two biggest success stories in the state of Texas. Year-over-year price improvement of 3.5%. From the pre-COVID date, 40.7% in Houston. That's a pretty strong success story looking over a 5-year period. And I'm always looking at the months of inventory and the days on market to get a little bit more of a predictive evaluation. And you look at it and you do see some slowness, right? Not surprising because of where rates are. Months of inventory, 3.8, 3.5, but a 4.4 number still well below the 6-month point of equilibrium between a buyer and a seller's market. And then the days on market pre-COVID was 59, currently at 52, just a shade over November of 2023. So not a horrible number there, but that months of inventory is a number that says there's a little bit of a slower moving market. The average lease price only up 0.5% year over year and up 25.7% from pre-COVID. So one of the things I find interesting here is that, and I feel this in my own portfolio, the average lease price has not gone up as much as the average home price. So I still think there's some upward mobility there. With that said, leases always lag home price increases, and you're already starting to see it, but it takes some time because the interest rates have gone up so much. We're going to show some slides later on that show how many people are moving away from wanting to buy homes in this current rate environment to becoming tenants. And that, I think, is going to continue to increase those lease prices over time. What do you guys think about that concept?
Yeah, I just look at these numbers, like you said. I look at Houston and Dallas compared to Central Texas, like San Antonio and Austin. They're clearly a difference in the two markets. Like Houston and Dallas have been very consistent, very resilient, despite, to your point, like despite rates being much higher and affordability being much higher. You look at the months of inventory, yeah, it's up, but not a lot, less than 1 month comparing it 5 years ago and last year. Same with days on market. Yeah, it's up a little bit from last year, but not a lot. Dallas is more of the same. Houston and Dallas are extremely resilient, very strong markets, especially when you consider compared to the brothers in Central Texas.
Yeah, and I can see why, it does take rental owners are slow to raise their rents, not because they're not worth more, but they're slow to raise them because they've got tenants they've had for 4 or 5 years. They're focused on tenant retention. They don't want to scare somebody off that's a good tenant. So they are slow to raise the rents. But as these things go vacant, you're going to see you're going to see them raising the rent up to that $2,200. That's a phenomenal number. I will warn people that this is all from MLS. So these are realtors. That's why it takes 37 days to lease it. If you manage your own property, it's only going to take you 7 to 10 days to lease it.
Yeah.
Why do you think there's a big difference like that, Steve?
Using a realtor is always the slowest way to lease a property. The reason is the realtors don't make much money.
Yeah.
They're not fired up to go do that when they can sell a house and make $12,000. Why do they want to go get a check for $2,200? It's just they're not motivated. Whereas a owner is motivated because they're getting, $500 a month positive cash flow or $300 or whatever. On a 2,200, it's probably $500 a month or more. They're much more motivated to get it leased.
Yeah, one interesting point. Whenever you say that, I was just thinking about this. If you bought that property back in 2019, and this is the power of owning rental properties. You bought it 1775, you're up to 2232 now, almost a $500 increase. So whenever you look at a 25% increase, that sounds good. But if you were making $500 a month back then, now you're making 1,000. If you're making
Yep.
200, now you're making 700. That's a very, very profound difference. And it's not really properly explained with that 25% increase. And that's the power of real estate over time.
Yeah. Well, I mean, remember what we said just a minute ago, like you're buying properties with very minimal cash flow, over time. Rents outpace insurance, even though taxes and insurance have gone up quite a bit, rents will outpace those. And it's, you buy properties with little to no cash flow. Eventually you're going to end up with numbers like this, where you got a $500 increase.
We've spoken a little bit about Dallas. Let's pop over there and do a little bit of a comparison. If you remember, we were talking about Houston and that appreciation over the last year, 3.5 from pre-COVID 40. So Dallas is up greater. Dallas slipped below Houston for a while and actually regressed a little bit, but they're really picking up steam again. 4.6 year over year, 64.6% from 2019. That's unbelievable. That's a fantastic number. And you look at it, it's still moving faster, especially with the months of inventory. Houston at 4.4, as Jeff said, Central Texas is a lot slower than that. Dallas only at 3.7 months. The days on market is comparable. Dallas 57, Houston 59. Also, the average lease price increase 27.5 versus the Houston number, which was I think 25.7. So I think Dallas is really strong over the long haul and is starting to trend up a little bit more quickly than Houston. And as Jeff said earlier, definitely a success story in comparison to that central market area. What else are you guys seeing here?
I see the run up in rents. I was just looking at that because it does. If I had a negative thing to say about Dallas, the rents going down $200 a month.
That's interesting.
That's pretty unique. Now, if you look at it relative to say 19, like Houston went up $500 and then was flat. Dallas went up $700, almost 8, and then dropped back down to 2. So they had an unusually high run up between 19 and 23 compared to say Houston. And they had, I guess you would call it a correction this last year on the rents. Still, was it plus $500, and Dallas and Houston's roughly the same. So it still is more of an increase when you look at the 5-year number. But I do feel like maybe Dallas was just a little too hot last year, and that's why the rents come down. I don't know, Steve, I know you have, so you guys have 2 offices, right? You have Houston and Dallas, correct?
Yeah, this is of course anecdotal, but we're not seeing any reduction in our rents. I haven't heard one member say, yeah, I had to reduce my rent. So that number may be inaccurate because it's just using MLS numbers.
I haven't seen any reduction in my rents. I've had some properties where the taxes have gone up unusually high, or maybe they're in a flood zone and my flood insurances have gone up and I have some pressure on my cash flows. That's for sure. But I agree with Steve. While I may have not had the increase detailed here on every property, I definitely haven't had any go down.
Yeah. If I look at on a positive note for Dallas, if you look at the 5-year number, 65% is 20 points higher than the next, right? I think Austin's nowhere near that. Houston was 41. San Antonio is not near that. So if you're looking for a clear leader with regards to prices and increases, I think Dallas is it for sure. Just looking at those prices, they have the lowest months of inventory. So it is definitely still a hot market for sure.
It's almost double San Antonio, which is pretty incredible. So let's go to that central market. And Steve, correct me if I'm wrong. You guys were talking at some point about maybe targeting a San Antonio branch. Is that still being considered, or where are you guys at on?
It's possible, but Phoenix, we're looking at Phoenix and Atlanta, probably more likely.
Okay. Those are
What's
big
the,
populations.
yeah, so what's the logic behind moving to Phoenix and Atlanta?
Well, our advertising and how we cultivate our members is primarily radio.
Mhm.
And those two cities have tremendous conservative radio stations. So we can actually get more publicity and do a little bit better in those cities than we would in Central Texas.
The population's pretty significant in each of those towns too. And I imagine you might have a little bit of overlay from your Houston and Dallas reaching into that Central Texas. I know you guys have quite a few members from Central Texas already.
We do.
You're not going to get as much, proximity marketing like you do currently if you're trying to get people in those in Georgia and Phoenix. So I think that's a great concept. Yeah.
Yeah.
Okay. So San Antonio, looking at the numbers here, definitely the weakest year over year numbers, down 5% on the average, 4.5% on the median. The months of inventory is definitely, I think, the closest towards that 6, which is equilibrium at 5 months. And then the days on market, also the longest at 72. Well, I take that back. Austin is 75.
Wow.
That's a lot of days on market. And even if you look at the rental days on market, 58 is a large number as well. They're relatively flat on the lease price. So, and we are also seeing this a bit in San Antonio. I do think there are some really good opportunities over there. And I'll say this, for real estate investors that are willing to get permits and understand the process and are willing to do good quality work, San Antonio is an excellent market. But I do want to caution everybody, whether you're doing work big or small, with the strike team in San Antonio, you must get permits. You must do it every single time. We do not allow any hard money borrower to not get the entire project permitted. And whether it's a small lipstick rehab, they're just really aggressive if you don't at least let them walk the property to ensure that something is not needed. Oftentimes they'll walk through and say nothing is needed with the repair budget you're doing, but you must have them rubber stamp it. You must have the permitting office rubber stamp that there aren't additional things needed. We've had some real, unfortunately, horror stories from people who try to circumvent that. And whenever you get popped, I would say that they're maybe even a little bit vindictive in how they approach it. So just do the right thing, spend your $1,000, get them to come out there, walk the property, say you're good to go. You keep the man happy. You get to finish your project and go on down the road. Like that's my strong encouragement.
Yeah. Couldn't agree more.
Yeah.
The man is undefeated as far as I know. So I would not try and fight that. I will say this though, to your point earlier about opportunity, if I'm a casual investor, the stories that you tell me out of San Antonio would scare me off. So I have to believe for those investors that are willing to spend a little extra time, go through that process, do their due diligence, you're probably going to get opportunities for better deals. You're going to, like
100%.
less competition. Less competition means if you're the one that's willing to go through the process, do the work, deal with the man, find good quality GCs, there's opportunities there to really, really, really buy a lot of houses without as much money as you would expect. You would normally need, say, in Dallas, right, or Houston.
I would echo what you're saying, Jeff. That if you're making sure that the contractor is not on the strike team, blacklist, that they've had a culling of the people there. If you're making sure you're working with approved contractors, that is a big part of it there. And there's something to be said. If you do a project and it's got a second set of eyes from the city on it, that's a nice rubber stamp that most people don't get in other markets. People in Houston and Dallas, we don't require them to permit every job. People don't always do it, but you're running a little bit more risk because you're not having the city's second set of eyes on it. So like anything else in life, like we talked about earlier, whenever people are afraid, those present the best opportunities. There are some people that are afraid of San Antonio right now, newer people that maybe don't have as much attention to detail or aren't willing to go through the permitting process or are afraid of it, have moved out. And you're right, Jeff, we see some stellar deals there right now. We're still doing a lot of deals in San Antonio, and the large majority of them are going extremely well. It's just really people who try to circumvent the system and the process to get in a bad spot.
Yep.
Yeah, that days on market for lease, that's ridiculous.
Unbelievable.
Ridiculous. That's why I say going through realtors is literally the least effective way. You really
Yeah.
want to lease these things yourself or have a third party that's going to get out there and hustle and get these things leased in 15, 20 days, not 2 months.
Yeah.
I appreciate the fact that you're focusing on that because, we don't often talk about days on market for leases here, but if you just think about it and do the math, if you're saying that, somebody that is motivated and knows what they're doing can lease these properties in say 7 to 10 days, and we're looking at what Houston was the best at 37, Dallas 47, and San Antonio almost 2 months. I mean, if you miss out on 2 months of rent and your margins are thin, there goes your entire year. Right?
That's
There's no
exactly
way
right.
to make that back up if you miss. Say you're $1,800. I mean, even if you got a good deal, you miss 2 months. That's $3,600 a year you're losing. Right? And say you're cash flowing $300. That's it. You're gone. You lost your
Yeah.
money. So that is an underappreciated aspect or skill, whatever you want to call it, is having the ability to get these properties leased and get a tenant in there paying as soon as possible.
Yeah. I give another pro tip that we always do is if we are not getting a lot of showings, positive feedback on showings at the pricing we are at, we drop 100% of the time every 10 days, and sometimes even 7, because if you drop $25 or $50, but you collect rent exponentially sooner, to your point, $2,200 a month in rent, if you miss out on an entire month, it's way better to lower the price $25, $50 and get it leased fast. That is very, very important. You can always try and get the upside on the next lease because you might have a better transition period once you get somebody in there. But on that first time coming out of hard money, it's very important to lease fast.
Yeah, I think you should go with the average for the neighborhood.
Yep.
What people do is they go, look, I just rehabbed it. It's in perfect shape. I want the highest rent I can get. But you stay days on market longer. You lose that profit. It's better to lease it at the average, get it leased, and then raise the rent at the end of the year.
100%. Yeah. And more often than not, if you rehabbed a very good property, you treat your tenant well, they are not going to want to move. It's expensive to move. You got to pay movers.
It is.
I mean, it's expensive. They don't want to move if you treat them right and you deliver a good product. And they'll
That's
throw a
exactly
little
right.
bit of an increase on the rent, right? Because you're going to pay movers and everything. You're going to pay a lot more money than that. All right. Steve, you were talking about the days on market there in San Antonio. You want to see a shocking number? Look at this November 2024 Austin number, 75 days. Unbelievable, right?
That's crazy. To me, that's overpriced,
Yeah, it's got to be. It's got to be. And you're looking at this number, 42.6% median sales price over this 5-year period. That is north of Houston and San Antonio, not north of Dallas, but a pretty strong history there over the long haul. But right now it's flat, and I hear a lot of people, and we see a lot of national prognosticators talking about how that central market area is some of the better areas to invest in because of that flatness. I feel like it was way too high, it went way too fast, but there's been a correction, and now it's presenting a buying opportunity. We showed a slide maybe 2 or 3 months ago where if you looked at the long-term steady appreciation trend in Austin, took this massive jump up, and then it came back to the trend. You remember that, Jeff? Like it kind of normalized with this decrease. So I think there are probably some really good opportunities either for flipping there at the moment or even in the outskirts some buy and holds. But the great thing about Austin is there's a lot more duplexes, triplexes, quadplexes. So that's a city that has a lot of them. Houston just does not have a lot of those, but Austin can make those numbers can work a little bit more by doing a multi-door property that still qualifies for that single family 1 to 4 loan product. Anything else jumping out in Austin, gentlemen?
No, I think you hit it.
Yeah, I think obviously the sales are still pretty significantly down. There's just not as much activity. And to your point, it's not falling anymore. It's flattened out, which is good for those people. but days on market, like you said, that's the longest days on market in the state, at least on the 4 metros we look at. It's still, I will say this though, even after all the beat up that it took, if you look at the 5-year run up, it's still on median. We don't have average in Austin for whatever reason, they don't do the average. But if you look at median, it's still number 1. They have had, as far as the value goes, sorry, not the run up, but the value. It's still the most expensive piece of property is Austin.
For sure. Next slide, please. So this is an interesting chart. You have 2 lines here. One is a red line that is the year-over-year growth in renter households. The lighter colored line, I guess maybe that's orange, homeowner households year-over-year growth. So this is not saying that, there are more renters than homeowners. We know that number's normally in the 60 to 65% range, but this is just talking about the year-over-year growth. And you can see at the moment in this higher rate environment that the year-over-year growth on rental properties currently is 2.7%, whereas the homeowner households is only 0.9%. One of the lower numbers you might see in the household growth, I'd say the rental household numbers is, up there for sure. What is jumping out on this report, Jeff? I know when we were reviewing these together, you saw some trends that were interesting to you.
Well, it's just the fact that the renter households is growing so much faster than homeowners. It's obvious, if you look at interest rates, affordability, people need a place to live, and they just can't afford homes still. I mean, the prices are so much higher. Wages have not come near, they have not followed the inflation nearly as high as far as the prices of real estate goes, or just the price of inflation in general. So you have a lot of people that need a place to live. So the renter, I guess, pool is increasing significantly. So if you're buying properties, I mean, we looked at Dallas, and Dallas, the rents were down, and Houston looked like it was a little flat, if I remember correctly. Houston was, up like $12. This would tell me that's going to start trending back up, where I think rents are going to go up just because there are folks that need a place to live. And I was looking at, like you said earlier, Steve, what do you think 2025 is going to be? A lot of the same. And if you paid attention to Powell, I think they slated just 2 rate cuts. They went from 4 to 2.
Yeah.
So I don't think rates are going to go down much. Inflation's it's not as high as it once was, obviously, but it's not 2 either. It's above their target. So I just think this is going to keep continuing. I think this is going to keep going up. You're going to see more people renting. They can't afford to buy a house. So if you're buying rental properties or you own rental properties, this is a good thing for you. You're going to have more people to choose from. And those average prices you were talking about, Steve, rent it for the average. I think they're just steadily going to increase for the next year.
Yeah, I totally agree with you. Robert Kiyosaki was talking about how the people renting is going to increase dramatically, like 10% over the next decade.
Was this recently?
Yeah, it wasn't too long ago, maybe 6 months ago. He's really, would it be bullish? I'm not sure. He's like, yeah, more and more people are going to rent.
He's pessimistic he was
pessimistic
pessimistic on the stock market. I know. Now, I think that may have been before. I know he's a little bit more conservative in his fiscal policy, so I don't know if that's transitioned since the election, but I know he's pretty conservative. Pretty pessimistic on the stock market. I just felt it was overpriced, PE ratios out of whack, things like that. But he always seems to be pretty positive on owning real estate. So I think that's his big baby for sure. One thing I was going to mention is like one interesting thing to look at on these rental trends. You think about what was happening in 2000, whenever both of them dropped so at the same time. That was the .com bubble bursting, right? You see that back in 2002-ish, both the households and the rentals really dropped. But then you had this period coming over toward 2006, 2007, 2007, whenever there was just an unbelievable amount of products for home buyers and for a steady trend there for a long time. Other than that .com crush, the homeowner starts were always way higher than the rental starts, right? Always way higher. Then you go into a period of after the great financial crisis where it's always renters. Renters were way above homeowners. Then you go into this recent trend where it's really been up and down, like a lot of
Yeah.
up and down over the past decade or so. But a lot of that was driven by the really low rates, kept the homeowners households growth really high. And then they had that moment at the beginning of COVID where people were just kind of like, oh crap, what am I going to do? I think I'm just going to rent for a while. Then rates went way down and homeowners went up. And now we're at the point where rates are way up and renters are way up again. So it really kind of follows two things, right? Stock market issues or financial issues, and then interest rates. I think those are the major drivers.
What
Yeah.
can you tell me? I'm curious. What was Kiyosaki's logic on why he thought it was going to stay this way for the
You
next 10
know,
years?
it wasn't just him. And all I heard was just what do you call it? A sound bite.
Mm-hmm.
Gotcha.
So he didn't have the reasoning behind it.
Gotcha.
Let's pop to this next slide. And I'm very interested, Steve,
I'm
you
gonna
guys.
have to excuse myself to the restroom. I'll be right back.
Yeah, no worries. In Steve's defense, he had his radio show for an entire hour right before this. So sometimes nature calls and there's not much you can do about it. Jeff, you and I can talk about this one for a moment. Maybe we can get
Yeah.
Steve's opinion on multifamily in a second. But, what I always look at is people who do multifamily, they're affluent, they're making big decisions. They raise money from a lot of very intelligent people, well-educated people. And at the moment, you look at this multifamily starts and completions, and they are at the highest level by far since 1994. That tells me that very intelligent people say there's going to be a lot of money to make as a landlord going forward. In addition to that, we see all of these big hedge funds and private equity funds buying tons of single family homes in order to hold them as rental properties as well. So in my opinion, when you see the smartest people in the room, smartest people in the country doing this with reckless abandon, just building as much as they can, buying as much as they can, that is a very strong indicator that it's a good time to buy.
Yeah, I think if you remember, for the last year or two, we talked a lot about housing, multifamily housing starts, and I think these are completions. So
Yep.
all of those record starts that we were talking about for the last couple of years are finally coming. Good God, look at 2020. Look at the number. Just draw a line from 2022 to now. I mean, that is a steep climb. But I think although wow, it's quick, Steve.
That's impressive, sir.
So 2022, like I said, we've been talking about the starts. They're finally coming to the market. And to your point, Wade, a lot of, if you're going to build multifamily, typically it's a lot of smart folks that think this is the right move. If you're going to have a contrarian view on what we were talking about previously, is that even though, there's a lot more renters than buyers these days, it looks like there's more competition coming in the multifamily space. So you're going to be competing against some of these multifamily places. Now, hopefully, you have a lot of folks that want to live in a home if you're buying homes and not a multifamily investor. But what do you think about this, Steve? I know you left when we were talking about it, but it's basically, if you look at the highlight, we're adding more multifamily units than we have since 1994. I mean, just look at the chart.
Wow.
It looks like it's the highest ever, I guess.
No, I mean, it's not even comparable. Up
Yeah.
until 2010, there was almost never a period above 300,000. Up until 2022, there was really never a period above 400,000, and we're at 600,000.
I'd be interested to see where all these are.
Good question.
This is a national number, I'm assuming.
Yeah.
Of course, see where they are and see, there's going to be a lot of talk of absorption and how fast they're going to be absorbed. It kind of worries me because these people that are building them, if they can't lease them up, they're going to end up having to sell them at deep discounted prices just to get rid of them. So I don't know if
too
they
much?
overbuilt, but it sure looks like it.
It's an interesting take.
Interesting perspective. I've always been of the opinion that, we'll look at this chart in a little bit. We've been so far behind for so long that it's a needed correction. But like anything in life, to your point, Steve, sometimes the pendulum swings too far. I don't know if that's the point or not, but sometimes the pendulum can swing too far. Let's go to this next slide, talking about great markets. This is a prognostication by the PwC consulting firm and the Urban Land Institute. It's talking about the top 5 markets to watch for 2025 and beyond. And looky, here we have Dallas and Houston, 2 of the top 3. And, Houston has not always been on this chart. Dallas has been on it more often, but that's very interesting. Just a subtle aside, most of these are in Sunbelt places with no income taxes or and very pro-business environments where they're really saying there's going to be a lot of growth, which makes sense. That follows the trend we've seen for the recent past, but very exciting to see Dallas and Houston there.
Yeah, it is exciting to see that. Yeah, I hope you'll email me this after this show.
Sure.
I'd like to read what they're saying about, especially Miami. That's interesting.
Yeah, we'll definitely send it your way. And if anybody on the call wants that, reach out to us. We'll be happy to get it to you as well.
It's a really sharp article, like really slick, easy to read. I like it.
They go to the next slide. It gives a little bit more of the context, right? So these are the different people who were interviewed, categories of people who were interviewed, right? So the biggest percentage of them are private property owners or commercial multifamily developers. And you got real estate advisory service groups or asset managers, some construction firms, home builders, private equity, real estate investors. So I think people who would really have their pulse on the situation have these opinions. So honestly, it's all anecdotal. There's not any objective measurement that they're using for this particular. I've seen other instances where there are, but this one is just polling 1,600 people that they consider professionals that gave their opinions on it. Also, whenever you go further down the list, not to leave out the Hill Country, we keep saying there's some concerning numbers there, but number 13 and number 15 are San Antonio and Austin, respectively. So some good news across Texas there.
Yeah.
This brings a lot of perspective, in my opinion, because to your point, we spent the first 20 minutes beating up poor Austin and San Antonio about how they're the little brothers to Houston and Dallas. And then if you look nationally, they're in the top 15. So we are all pretty blessed to be living here in Texas when it comes to the real estate market. You could be in, the real estate deserts of a lot of other markets. Like you said earlier, I was looking at the top 10. I think 9 of the top 10 are in southern states, if you include Arizona and the South. So it is really interesting to me to see how, like to your point, Steve, on the slide before, how a lot of these things are national, but when you look at individual markets, there's some huge disparities.
Yep, for sure.
Yeah. Now, are they saying these are the best places to invest?
Yes.
Yeah.
So this
makes a lot of sense.
This is forward looking. And that's one of the things, Jeff, whenever we're beating up San Antonio and Austin, that's a lot of looking at the past, right? This is more forward looking. So that makes some sense. I'm sure that they said what markets have done the best over the last year. I'd be shocked if Austin was in there for sure, right?
Yeah.
Well, if you just look at the fundamentals, even in a place like Austin, which we consider overpriced relative to the rest of the country, it's not. It's got good population, good job, good education. Like there's still a lot of just tons of commerce there. Like there's just fundamentals about Texas right now. No, very little. It's losing me the word, but regulation. Sorry, you don't need to get doesn't take you 2 years to get permission to build something. So it's, like I said, we are very lucky to be where we're at.
Let's move to the next slide here. I'm just going to grab a couple things here that stuck out regarding why they think Dallas, fourth fastest growing U.S. city, population increase of 6.1% between 2020 2023, trailing only Jacksonville, Raleigh, and Austin. And then the metro area has seen annualized 5 and 10-year returns of 7.9 and 8.8% respectively, and the top quartile of this property index for both periods. It's the only Texas MSA with that distinction. I'm just going to grab Houston real quick because we're at the 145 point. Of course, the energy capital of the world. Houston is home to 26 Fortune 500 companies and ranks in the emerging trend top 10 markets in 10 years. So although it had moved up to the top 15 markets in the last 2 years. So little information on those two. I do want to go to the next slide and get the opinions of both Steve and Jeff on this one, just go a little bit slower. So this is a Realtor.com price forecast for median sale and percentage of year-over-year growth. Jeff, I know you liked this report the other day. What's your opinion then? I'd love to hear Steve's as well.
Yeah, I mean, it's kind of more of the same, right? We talked about, and I think it was very very good prognostication, Steve. I do expect, look at the forecast. Buyers should expect a friendlier, less competitive housing market, although one that remains costly due to still high mortgage rates and home prices. So I don't think things are going to change much, to be honest, when it comes to the market. It may be a little friendlier, I suppose, but I think this is going to be pretty similar to 24.
Yeah, I've got to say, this is an interesting way they did it with the year over year and the sales price per thousand in thousands. Yeah, it makes sense because it's still, yeah, there's a little bump there, but it's still pretty flat. You're not seeing a big spike anywhere in 2025. So yeah, I would have to agree with them. And I know they won't be perfect, but yeah, I agree with them. There's not going to be any major event in 2025.
Good points. Let's go. Let's skip the next slide and go to this page 18. Sorry, yeah, that's this slide here. I really like this slide. Want to talk through it a little bit. So this blurb on the right says the average home price nationally is about 50% higher than at the onset of the pandemic, more than twice the increase of the median workers' earnings.
Wow.
That's a shocking number right there. To think that if the average home you were going to be paying, let's just say in Houston, you're going to be paying $2,000 a month to buy a home back then. Now it's $3,000. Like that is profound, right? That's a huge to go up 50%. And we're seeing that trend, right? Moving so many people towards rentals. What else? I mean, what are your thoughts on this chart here?
Well, this could be why Kiyosaki was saying there's going to be more renters.
Sure. For sure. I mean, it's just hard to, if you want to buy your first home and all the home prices have gone up in price across the board, then to exacerbate things, the interest rate is significantly higher. It's just tough to break in. Just tough to break in. This chart really shows it. I thought that blurb about being 50% higher was incredibly strong.
I do have a question. I don't know, Steve, I don't know how in tune you are to new construction, but with, I remember during COVID and even afterwards, just the reason why they were not able to keep these prices from spiking was because the cost to build a new home, even if you call it a starter home, is so great, so much greater than it was pre-COVID. It's kind of hard to come to the market with an alternative to maybe try and get some folks that can't afford what's out there right now. Do you have any insight into that, into builders and the cost that it is to build these properties, multi or single?
Well, I do know of quite a few projects of build to rent, but build to sell, I don't really know much. I know that I'm still hearing complaints about wood prices, that they have not come down to pre-COVID numbers. So that adds to the square foot cost. But I don't know if the costs have gone up that much. You know, it seems to me that people are just paying more, as opposed to there's a specific reason why these guys are charging more.
Okay.
Does that make sense?
Yeah.
In other words, I don't think the prices to build have gone up 50%, but the market has gone up 50%.
Well, and I'm pretty sure this is not just talking about the home price. This is talking about the total affordability, which includes interest rates, increases in taxes, increases in homeowners insurance, et cetera. I don't think I think so. That's a fully baked number. It's like the person's debt to income ratio. It's the monthly housing expense, right? So I think that's the driver here. So you have a lot of factors going into that 50% increase beyond just the price. But all right, let's look at this next slide. And Steve, whenever you were talking about, you know, those numbers being concerning to you, which are concerning to me too, and I appreciate you shining a light on it on the big increase in apartment completions. Well, this is the number that always gives me some comfort as an investor that you know, that we're building so few homes. You know, you look at in the 70s, how many homes we're building, exponentially more than at any time over the past, you know, since 2010, 14 years. We were building from 2010 to 2020 fewer homes than in any other decade on this chart since the 50s. It's just, it's hard to wrap your head around how few homes have been built. It's really shocking. So it does seem as if there are more apartments being built because people anticipate it's going to be harder and harder in America to buy a home. And it's easier and more profitable to rent in most instances an apartment complex, right? It's better use of land. If you want to get a bunch of people into a smaller space, makes perfect sense. But for single family investors, which is the group we work with, this chart really is just, in my opinion, saying the population has gone up exponentially. That's the total population line, right? Like it went from 160 million to 340 million, more than doubled, and we're building significantly fewer homes. It's hard to wrap your head around. But to Jeff's point, I think a lot of it's regulation. It's tough as hell to build a home right now. It's not easy.
That's exactly what I was just thinking. I was like, I wonder how much of that is it's just too much of a pain in the ass to build houses sometimes.
Yeah. That's all. I mean, every time I look at this chart, it's hard to wrap my head around, and shocking. The numbers are shocking.
Especially, you know, during the Great Recession, 8, 9, and 10, when you see that massive drop, that's insane.
Yeah, just incredible, right? And even at that point, even when we thought people were building homes with absolute reckless abandon, it was not more than in the 70s.
Yeah.
For the most part, right? There was 2 periods in the 70s that were right up there, and 1 period in the 70s that was significantly greater. Right? That's crazy.
Yeah.
Anyway, so you know, like most evaluations, this one is complex, right? There's some indicators that say there may be some overbuilding, possibly in multifamily. This still says it seems like there's not enough building in single family. So some competing information there.
Yeah.
This next chart, rental vacancy rate. Jeff, what are you seeing jump out here?
Yeah, I mean, it's just kind of the same, right? We talk about how when home buying is, when it's easy to buy a home, you're going to see the vacancies go up. You know, now that I am a little surprised as to why seems like it's going up a little bit, right? Because, I mean, I'm trying to talk through this, but if it is more difficult to purchase a home now than it was in the past, you would expect rental vacancies to be going down because they need a place to live. So I am a little curious as to why it seems to be going up. I don't know if you guys have maybe I'm missing something here, Um, because in times of free mortgages and loose underwriting guidelines, right? It's the like the 2000s and up to 2010. It's difficult to keep people in rental properties because everyone can buy a house, right? The American dream.
Yeah.
And so as it gets tighter, you should have less vacancy, which is what we saw, right? Starting in 10, a pretty steady decline in the vacancies, but it's starting to shoot back up. So I am kind of curious as to if you guys have an opinion or why you think that is.
I mean, maybe to Steve's point, the number of apartment complexes that are coming online.
Could be.
Maybe.
Yeah, but I'm with Jeff that it's odd.
It is odd.
It doesn't seem to make sense.
I agree, it's odd, but maybe Steve, you're seeing something in those completions that they're sopping up some of the, if you think about it, you got a 500 door apartment complex come on board or 250 door apartment complex come on board, and you're having quite a few of those pop. May take some time to get
Absorbed.
tenants in that area and get absorbed. I don't know.
I'm
Yeah,
really
because
curious to see what
the quality of lifestyle in these apartments now is insane.
Oh, yeah.
3 pools, gyms, jacuzzis, golf simulators. It's crazy what they're putting in these apartments now.
Yeah. It's like having going to Dave and Buster's within your apartment complex, plus a
Exactly.
water park and everything else. It's gonna be crazy.
So the quality of lifestyle is so high in those apartments. I think people could be opting for the apartments and giving up the yard.
Yeah, it's a good possibility.
There's a lot of expenses, even if you're renting, there's a lot of expenses that come with that, right? It's just the cost of living in there is, and buying the house, obviously, even if it's just the monthly payment, there's the expenses of maintenance and whatnot. So I could see that. I'll be curious to see what this does over the next year or so.
Absolutely.
If it starts going back down.
We got a few minutes left. So let's go to the affordability index, which is always one of our favorites to review. Let's see how the state of Texas and the major metros are doing. As a reminder, we've got the top left-hand corner, December of 2019, which is kind of pre-COVID time frame. We got December 2023, 1 year ago, and then we've got current. If you look, Dallas was the 21st least affordable market. Houston was 26th least affordable. Austin 29th. Then you got San Antonio at 55. December 2023, Austin jumps Dallas. It's number 22. Dallas is 25. Houston 42. Houston dropped quite a bit from 26 to 42. Then you got San Antonio way down at 67. Currently, Dallas jumps Austin again. Dallas is the 19th least affordable. Austin 25th. Houston down to 32, and San Antonio at 62. And I always think, like, you think about the amenities in Dallas and Austin and Houston compared to these other cities, and the fact that you only have to spend 43% of your income for housing, and then you go to other cities that I think are comparable from amenity perspective, like a Miami or New York, you're talking 84 and 72%. That's just unbelievable, honestly. But I think that also gives a pretty strong reason as to why so many people are moving to Texas.
Yes.
What else is jumping out you got?
Los Angeles, Miami, New York, Anaheim. Good Lord.
So I see these things that I noticed a couple. These are the ones at the top are clearly like a have and a have not, because there's no way the average citizen can pay 96%, right? So there's just so many people that are renting there. But I'm curious because you mentioned earlier, Steve, you mentioned Miami. It doesn't seem to fit in those top 5. If you look at the numbers, you look at the income, 80, 130, 80. Now, those are pretty high numbers for an average income. Miami's 57. So I'm not quite sure what the dynamic is in Miami and why this is it's so high on that list. I also think back to Stephen and the mayor of Lubbock, and it's down there 87. 20. It's those college towns. It's a great opportunity to pick up some rental properties. I know that for sure.
You know what? One thing I'd mention: these are, if I recall, and I'm pretty sure I'm right on this, average home prices, not median. And I think in Miami, you have so many oceanfront properties, and those homes are worth absurd amounts of money. right? Even a
That would
condo
make
is
sense.
a third amount of money. And you don't have that pulling it up like in Dallas and Houston, these just absurdly priced homes because they're on one of the more beautiful parts of the ocean in the United States. So I think that probably plays into this a lot. One other thing I do want to mention, whenever I think about San Antonio, with all the things that may be perceived as negative, look at San Antonio, right? The average income in San Antonio, 62.8. It's within a breath of Houston. But look at the home price, 285, Houston 363,
Wow.
Yeah.
right? And you look at Dallas, 67, San Antonio 62.8, Dallas 435. Now, Dallas is more broken up. I'm going to give them, like, they got Irving at 80,000, Plano at 111,000. So you have some pockets in there where the average income is greater, and Dallas is a little bit chopped up, so it's somewhat confusing. But still, I think San Antonio, you're looking at it, not
Houston's
the
not.
amenities of the other three towns, but dang, they can pay for a lot more in price and rent there, in my opinion.
Yeah.
So,
So Steve, we're up against it. It's 2 o'clock. Tell the people if they wanted to get with your Total Wealth crew. What do you guys have any? You guys have any events going on or coming up, or what would they do?
Yeah, if you're what Total Wealth Academy does is we take people pretty much by the hand and teach them how to use real estate to build a second stream of income. This is the business model that works. Saving your way to retirement is not effective. It's better to build a second stream of income. We teach them how to do it with single family homes actively or passively with big apartments, self-storage, and so on. And if they're interested in finding out about the mentoring, the best thing to do is go to totalwealthacademy.com and check out our free sample class.
yeah, and I do strongly encourage that. We have one question. I'd love to ask it of Steve. It's a question from the group that Derek made me aware of. Steve, what is your advice for, year-end tax decisions? Do you have a couple of little thoughts on that for year-end for real estate investors?
I don't.
Okay.
I am not one of those guys. I have a CPA. He takes care of that for me.
Yeah.
So I'm not the right guy to ask about tax.
I will give two pieces of advice. If you haven't done any investments this year, it's a tight window. But if you work with the agents that Steve works with, they may have some properties for you to get one in by the end of the year. Because if you made a lot of money this year and you don't have any depreciation on your real estate is a great way to offset tax. So you might be able to sneak one in before the end of the year. And then secondarily, if you're just talking with your CPA about tax decisions, they may tell you to expense everything in year one. Us as lenders, if you want to get conventional loans on your refi, it can put you in a really tough spot because if you expense everything, it can really make your income look a lot worse. If you amortize or depreciate things, you're able to add those expenses back and you still get the same tax advantage, but it's stretched out over time. So that's just something to keep in mind. And then lastly, I do want to award our winner for today. That is Amador Lopez, and you get half off your next processing fee with Catalyst Funding. Steve, as always, thanks so much for coming out, buddy. Look forward to seeing you at the next event.
Thank you for having me. That's fun.
Absolutely. Have a great one. Thank you, Jeff. Thank you, Derek. Everybody have a great day.
Thanks, Steve.
Thank you.